Hello, everyone. Welcome to RealVision Live. For RealVision, I'm Max Wiethe. I'm joined today by Danielle DiMartino Booth, the CEO and founder of Quill Intelligence. She's been on RealVision many times before. Thank you so much for coming back, Danielle.
Great to be here. Happy belated New Year. It's still January. We can say that, right?
Yes, exactly. And that means it is still the season of 2021 outlooks. And that is what we're going to be doing today. I got to take a look at some of your views ahead of time. So I know we're going to talk general, the real economy, your outlook there, the important stumbling blocks, roadblocks that we have ahead of us that need to be ironed out should this recovery narrative really take hold. And then bond market, equity market, and commodities and FX. Why don't we start with the real economy and what you think are the hurdles that we have ahead of us to keep this recovery narrative afloat?
So I think the most obvious one is a word that we're hearing a lot more of these days, and that is scarring. You're starting to see in the foot race between temporary unemployment and permanent unemployment, you're seeing permanent unemployment start to win the race. And 2020 was a year in which the narrative was all about, we're going to bring these temporary workers back online once we reopen the economy. Well, guess what? A lot of the U.S. economy is reopened. And yet, you're seeing permanent scarring in certain industries. You're actually not seeing a dissipation headed into 2021. You're seeing an acceleration of small business closures this year. I think a lot of companies said that, I'll hold on until the end of the holidays. And then you have this latest wave of the virus make its way through the economy, and they threw up their hands and closed. So I think that I think if there's a challenge for 2021, it is that the market has so priced in the post entire country being vaccinated that there's this risk for the stopping and the starting. We don't know what we know that hospitalizations are down big time. We know that case counts are down huge, even though yesterday we had the second highest death count, daily death count since the pandemic hit U.S. shores. By the same token, we don't know what this next variant of the virus is going to look like.
Yeah, as far as that goes, there's two aspects of it. I've been talking to Ed about it. He calls it, the length of the tunnel. They've said we can see the end and we know exactly how long the tunnel is. And the question is really, one, how long is the tunnel? And then two, how much damage is going to be done regardless of how long it takes. You talked about small businesses being a big place where we're seeing closures and unemployment. We had light stimulus that came through that helped in some ways. It generally hasn't made its way all the way down to the small business level, but stimulus coming from the new administration is certainly what you're talking about in terms of pricing in a lot of positive. How are you thinking about the potential for stimulus, how important it's going to be, and really if it's enough? Is it true stimulus or is it getting us halfway there?
So this is my biggest pet peeve. I mean, by a wide margin, and that is that if you look at some of the return on investment in other countries, they're actually doing things with the money that they're spending from the public purse. If this $1.9 trillion goes through, and that's a huge if you look at the infusion to personal income, household personal income in the aggregate rose more in January 2021 than it rose in April of 2020 with the initial CARES Act. Think about that. So there is a ton of money that has just been put.
Sorry for interrupting your video, but I have an important message to share. At RealVision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on RealVision's YouTube channel, that is just the tip of an iceberg. You should come over to realvision.com and see how we are not leaving any stone unturned, from publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts and fellow subscribers and learn from everyone's experience. It is an experience which you live and you learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1. I don't think you can afford to be without it.
In January 2021 than it rose in in April of 2020 with the initial CARES Act. Think about that. So there is a ton of money that has just been put into the economy. Alaska's Lisa Murkowski, Mitt Romney, they're two kind of moderate Republicans who have already come out and said, you know what, the ink's not even dry on the $908 billion stimulus that they fought tooth and nail for 8 months to get through Congress. Let's wait and see what that does for the economy before just throwing more money out there. Wall Street wants none of it. Wall Street wants that $1,400 to go out into the economy now. There are a bunch of day traders who are right there with them, rooting it along, who are still, they've like made their livelihoods out of trading stocks in their parents' basements. So there's a mathematical truism to the stimulus juicing GDP growth, but as a country, we're not getting anything out of it, which means that we'll be back at the discussion table come September, if they get this whole package through, saying, what's the next round of stimulus going to look like? Here's another fiscal cliff, because again, there is this element of economic scarring. There will not be people going back into office buildings in the same numbers, ... for a generation, possibly. And we know from speaking to CEOs and CFOs that they view the line item of expenses of business travel completely differently now that there is obviously this ability to do things virtually. They can save a lot of money if they're not putting somebody in an airplane business class and parking them at the Four Seasons somewhere for 4 nights out of the week. So the commercial real estate sector is something that is going to take a long time to work out. The travel industry is also going to take a long time to work out. And again, none of the stimulus money being spent is going towards infrastructure yet or jobs reskilling yet. And God help us if Joe Biden uses all of his political capital and gets this huge stimulus package and then has trouble down the road with infrastructure or something that could actually create long-lasting economic growth in this country. So did I mention it was my pet peeve? Huge pet peeve.
Okay. We got a question in from Patrick who wants to know if you have any thoughts on, I know you're close with Ben Hunt, on his recent article on the B117 variant of coronavirus.
So, we keep thinking that we've figured out the virus, and the virus keeps slapping us in the face and saying, but wait, I have yet another act. So I think that it's kind of how monetary policy used to work, with a lag. That was the first thing they teach you, your day one at the Federal Reserve, that monetary policy acts with a lag. Well, we need to look at what is being experienced in the UK right now and say, wait a minute, if it just got on US shores a few weeks ago and it spreads more rapidly, then we're going to have to wait a period of time before we see this thing butt its ugly head sometime in the first quarter. And it's kind of like having a weather report in hand that says there's a tsunami coming. We just can't tell you when. So be prepared, but we can't tell you when to be prepared. And that's kind of how this virus works and why it maintains record high levels of uncertainty in the market, which is going to keep the occupants of the C-suites in a cost-cutting mode. They're not going to make capital investment. They're not going to increase hiring until the variable of the virus quits being this great unknown. And to Ben's point, we don't know when that's going to be.
Yeah. Now, one aspect of the real economy we didn't touch on is residential real estate. There's an eviction moratorium right now. Certainly, it's hard to think about psychologically, because if you're, possibly going to be evicted, or if you can't pay your mortgage, it's hard to imagine, that you're much of a consumer on the margin. But I'm sure there are people who just aren't paying it and still consuming at the same levels that they are. What's going to happen when
we had the data came out last night. 2020 was a year that saw record low foreclosures. So we are in the midst of 15 million Americans collecting unemployment insurance benefits in some form. And we have not had a household credit cycle. It is frozen. And if you look at the $1.9 trillion stimulus, it looks like it's going to keep the foreclosure moratorium going. It looks like they want more forbearance. So if you continue to have a market that is operating inside of a vacuum, low supply, Until the vaccine is disseminated, you've still got a ton of people who don't want to even have an open house. And yet you have this continued rush because people are like, home prices are going up. Cash out refinancings at $100 billion run rate per quarter. The amount of money, the K-shaped economy my buddy Peter Atwater talks about. The people on the upside of that K, they are pulling money out of their houses. They are spending money like luxury car sales in 2020 were through the roof. So if you're one of the haves, you've never had it as good as you have it right now. And if you're one of the have-nots, you're constantly watching to see when Congress is going to extend whatever the moratorium is. And as you see reflected in the stock market, any money you get from the government is going to be spent in full. And that is why we have such a robust and false economy right now.
Now, is the big risk it blowing up on the haves, or is the big risk, political strife coming from the have-nots? So
coming into 2020, we had kind of corporate debt, which is one of my big hot buttons. Corporate debt to GDP was 78%, not all non-financial debt. That was a record high. It's probably pushing 90% now. And my buddy Philippa Dunn, she tracked the Case-Shiller 10-year PE CAPE ratio back to 1881 because that's what she does. She's a data queen. So she tracked it back to 1881. And if you post inclusion of Tesla in the S&P 500, stock market valuations are in the 99th percentile. So I'm marrying the two thoughts together. The corporate bond market, which is a feed-through mechanism to the equity market, was an accident waiting to happen going into 2020. And we had a big black swan. But fast forward 12 months and valuations are more out of whack than they've ever been. Even as you hear Bubble Vision say, we're at the advent of a new roaring 20s secular bull market. To put this in perspective in terms of where the PE ratio is today and where it was at its low point in the history of mankind, December 1920, so exactly 100 years ago, it was 5. It is a multiple, the PE ratio is a multiple of 7 times that level today. So you cannot tell me with a straight face that we're at the advent of a new bull market. Are we in the middle of a melt-up that is being juiced by fiscal spending that puts every other developed nation to shame? Yeah, we are. Does the stock market like all the cash that's being spent in a 70% consumption GDP economy? Yes, it does. But it won't take a big black swan to knock it over because valuations are so much more stretched than they were 12 months ago.
Okay. Well, let's get into how the market is reacting to all this madness, and we'll start with the bond market. So, what is it that you're seeing in the bond market and your current views?
So a year ago, when I was looking forward, Morgan Stanley did this my favorite chart ever. And it shows basically if the credit rating agencies were being honest, what would the portion of the investment grade corporate bond market be rated if they were not being inflated the same way they were in the subprime prime crisis? So a year ago, it was about 38% that they deemed this swath. Think about it as the portion of the corporate bond market that the Fed bailed out, because otherwise it would have all been downgraded to junk. But the Fed grandfathered in junk on March the 23rd, 2020. So 38% headed into 2020. Today, we're at 56% of investment grade bonds with inflated ratings that should otherwise be rated junk. While borrowing costs for companies are at the lowest, junk bond yields are at the lowest level in the history of mankind. I keep saying these things because we're in uncharted territory. And the corporate bond market is a reflection of this. But again, you've got Janet Yellen coming into Treasury. I mean, this is like the fairy godmother, but there's no cavities with her. If she's the tooth fairy, there's no penalty. She speaks very sweetly. And what if new facilities need to be rolled out so that we can bail out the corporate bond market while assuring people that it does not need bailing out at the same time in a very calm voice? Well, then we can do that. And her lovely friend Jay Powell will be there to assist her.
And she's even asked to get more powers. I think earlier, earlier this year, maybe even end of last year, she said that the U.S. is incredibly, handcuffed compared to their international counterparts and their ability to step in.
Oh, how sad. We can't buy stocks. Oh,
basic. I mean, that's essentially what she said is like, it'd be really great if we could buy stocks. Just the market knowing that we could and we were there and it's been approved. It's all legal. When
the facilities were set up with BlackRock way back when, somebody who's really smart and bored and had insomnia read the fine print. And even though the Fed was technically only engaged in the corporate bond market, in the fine print of the BlackRock agreement with the Fed was equities.
Yes, maybe it was a standard boilerplate contract. I don't know, but I know exactly the wording you're talking about.
With the biggest central bank in the world. There is no boilerplate.
Yes. Okay, well, before we get back into corporate credit, I'm sure people want to talk about treasuries and the yield curve and what you see happening there. You said in your note that you see 10-year rising towards 1.5% towards the back half of 2021, early 2020. We're over 1 now. I forget where we are today, maybe 1.08. How quickly do you see us going there? And what about the rest of the curve? Is this going to be a steepening that the Fed is interested in? And what about the potential for yield curve control? When do they step in?
Well, we have really seen steepening. We've way seen steepening. And, I've been of the opinion that the Fed wants to implement yield curve control. And there was this stubbornness in the market until you really saw those Georgia Senate elections get decided. And then the bond market broke free from a range of 0.85 to 0.95 on the 10-year. The longest range in the history of the bond market was held in that 10 basis point level. We've never seen such stagnancy in such a tight range. And then it broke free by 40 basis points once you saw those 2 Georgia Senate seats flip, because the bond market said, well, maybe we will print enough for the inflation genie to get let out of her bottle. But I'm going to channel my inner Lacey Hunt right now. And unless it's something that allows for the true monetization of the debt, which would require an act of Congress in reopening the Federal Reserve Act of 1913 and delivering money, and Janet Yellen has been talking about this nonstop, because as a labor economist, we have to remember she's a UC Berkeley trained labor economist who it is in her face that her legacy at the Fed was not being able to deliver on the second mandate of maximizing employment. So if you're bitter about this and in her position, what do you do in order to truly finally get money to the people? Because the banks are not taking the money that is being created via quantitative easing and making loans to grow the economy. The Fed's models are not working, but you could do helicopter money. And if you were able to deliver money directly into the hands of people, which Lacey Hunt says is not going to happen, then you're going to get real inflation. And it won't be kind inflation. It won't be the kind of inflation that the Fed can control. It'll be real inflation.
Isn't that kind of what they want, though, to monetize the debt, cap the yields, let inflation run wild, have those negative real yields, fund everything for them? Isn't that the whole goal? Well,
it would be a goal inside of a vacuum. But the fact is we're a levered economy. There is the sheer percentage of high yield credit is the lone exception in 2021 where there's not a big refinancing wall. But there is a massive amount of investment grade bonds that have to be refinanced. There is a massive amount of commercial real estate that has to be refinanced in 2021. So if you're the Fed and all of a sudden you have rising rates that you've been asking for, and yet you have risky assets blow up to kingdom come, that's a little bit of an unintended consequence. And in other words, they have to be careful about what they ask for, because the rest of the economy is so levered up. They can inflate away existing debts, but you cannot refinance what has to be refinanced in the private sector. And that's very problematic when you consider the scope, the size, the magnitude of some of these markets we're talking about.
Okay. And then as far as, once we do hit that 1.5 percent level in the 10-year. Are you thinking that that's going to be maybe the start of another bull run in treasuries? Is this something that you would be fading to 1.5 and buying there? How are you thinking tactically?
So I think that we would certainly see the 1.35, 1.5 level on the 10-year as being a buying opportunity. Again, you have a massive output gap that's going to take years to close. You have permanent unemployment that is in the same vicinity as the great financial crisis and the double dip recession of the 1980s. So permanent employment right now is higher than it was in the 2001 and the 1990-1991 recession. Permanent unemployment. Those types of things are disinflationary by nature. The baby boomers aging, that is disinflationary by its very nature. So that is why it's been so incumbent upon the Fed to juice the housing market so that they can create wealth where possible. And the illusion of rising price, well, there's no illusion. House prices are really rising. I've been in the market to buy a home now for the past year in a place where people who live in Chicago flee in a post-COVID world. So it's real. The home price inflation is very real. But again, that does not address the underlying sclerosis in the real economy that is disinflationary in nature.
Okay. Now, as far as investment grade, in your note, you said you're looking at a hybrid barbell approach where you're holding shorter dated, higher quality investment grade bonds, while if you're going out in duration, you're looking at, high yield, but better quality high yield. You're not going into the nastiest of the junk.
Yep.
Can you talk about why that is the strategy you're looking at?
So up in quality, higher duration junk. Again, junk does not face a huge wall of maturity this year. So there are a lot of companies that populate that universe, again, up in quality towards that investment grade floor, that are a safer bet, in my view, than some of the longer duration. Again, the investment grade corporate bond market, 56% should be rated junk, and the duration in that market has gone out to kingdom come. So the interest rate sensitivity of that sector is enormous. So stay short on one side of your barbell, investment grade, and stay high quality, high yield.
Okay. All right, let's move on to the stock market. So I'm looking right here. The first sentence, the U.S. equity bull run has run its course. What does that mean for you? Because maybe it's run its course, but it doesn't know that. How long of a course does it think it's running?
You're asking about how long melt-ups can last. So I have no flipping idea. What I can say is that the discussion is something that is reminiscent not of 2007. You have to go back to 1999, 2000 to get the tone that you're getting from the people who are defending the new paradigm arguments. The fact that we have new paradigm arguments is indicative in and of itself. The fact that you have the SPACs that are just laughable. And the way that they're structured, such that the people who create them get their money out and everybody else gets screwed, and they're like, that's okay. The sheer amount of negative profitability Nasdaq stocks is technology stocks is
not even the number, but their performance, not just the number of them, the sheer volume of non-profitable Nasdaq stocks, but the fact that they're outperforming.
The biggest company in the Russell 2000, PLUG, plug. Look, there is some really whacked out behavior going on. And all I do for my gut check as to where we are in terms of being in a melt up, I just look at how angry people are on my Twitter feed. If anybody ever even questions whether it's the Bitcoin or the Tesla narrative or the SPAC narrative or ARK, they go nuts. And they remind me of when I was on Wall Street in 1999, 2000. And you could tell people, that Cisco Systems is going to be a great company. It's going to be with us for a long time. It is. But you remember what Mr. Buffett said, that a great company does not mean it's a great stock. The fangs would come out. And I watched people's net worths melt because they refused to get off the ship and at least take out what their cost basis was and let the profits run. And that's why I used to have a sticky when I was up in New York, and I kept putting new tape on it every year, and it said, "Pigs get fat, hogs get slaughtered." But we're at a point where nobody believes that there's a slaughterhouse. Nobody. Very few people.
Okay, so if you do believe it's a slaughterhouse, then what are you doing? Is there any pockets of safety? Is there, you mentioned, taking your principal out and letting your profits run at this point? That's, I'm sure for most people, moving significantly into cash. Mm-hmm. Other than that, is there any pockets of value or safety out there?
Well, the thing about stock markets, when they get to be this stretched, is you tend to throw the baby out with the bathwater if the dam ever breaks. That being said, I'm Huggy Bear with my municipal bond portfolio, and I'm not that old. But I'm not moving at all with my gold and silver positions, and I'm exposed through an amazing fund and a guest who's been on RealVision with some frequency. So I'm completely exposed to the fact that volatility is also stretched. And as a person, I have made a habit in later life, in a post-Fed world, of investing directly in companies. And I still continue to look for seed opportunities.
Okay. So yeah, venture. I mean, that's something that so many people are turning to. So many big investors. We had Jeremy Grantham on talking about he's got 70% of his personal wealth in venture, and he's the value asset allocation, grandfather. Dan Loeb raising a VC fund, things like that.
Look,
so many people are turning toward private markets.
The Phoenix rises from the ashes. It's a fact. This is an enormous economic shock, COVID, but there will be industries, plural, that will come out of this situation, and they'll be the next generation of, I don't know what, but I want to be there on the ground floor.
So my thing there is, isn't that exacerbating the haves versus the have-nots? Because the haves get access to these markets. They're able to do that. And then the have-nots have to pick between the madness in the public markets, trying to navigate all this craziness where all of the sophisticated investors, accredited investors, institutions get to say, I don't really want to participate in that. But I do recognize that there is so much change going on, so much innovation. And I'm just going to focus on that for the moment because there's no opportunity over here.
Well, so here's my deal. People need to read the fine print of their 401ks. They really do. It was years ago that I self-directed. I looked at the choices and I'm like, they've all got huge disclosures. That's a red flag. And there's a finite number of choices, and there's a conflict of interest between my employer and what the choices are. So I think the most important thing that individual investors can do at this point, we're talking about 55% of Americans who own stocks. So you're talking about a sub portion of the K, by the way. You're not talking about the real bottom of the K, 45% of Americans who don't own any stocks. Yeah. But for the people who are kind of trapped in certain vehicles, it's time to self-direct your 401k. And if you need to go to the mattresses, I'm Italian, these are technical terms, but if you need to go to the mattresses, make it to where you can. And at least live to tell and be there for the next generation of value investing when it finally comes back. So all I'm trying to say is, and by the way, I'm not in a VC fund per se. My family literally is seeding companies. Yes. Yeah. I'm talking about embryo investing, itty bitty. But to your point, I think that one of the greatest travesties of the investing construct is that so few people have an escape hatch with their retirement savings, and there has to be the ability to self-direct.
Yeah. Well, perhaps it's not a K-shaped recovery. It's more like a Chinese fan that has expanded, and you've got people going straight down and people going straight up, and everything in between. And it seems to be based on opportunity.
Yeah, look, on a personal level, I try my best every day to not buy from Amazon. I mean, it's a philosophical statement. I have nothing against Jeff Bezos, but I kind of do, because he puts so many businesses out of business. It's part of his business model. But there are things that we can do as individuals to try and fight what COVID is exacerbating, which is the oligopolization. And you hear about Office Depot and Staples. And I'm like, look, we're going to have one more gigantic big box, one footprint retailer in the space. And because of COVID, all the small business players are going to go away. So in a post-COVID world, we're going to have what my buddy Jeff Gunlack always says, that 38% of the S&P 500 is big tech that employs 2% of Americans.
Yeah.
So whenever and however I can support small businesses in a fundamental way, I do.
Yeah. All right. Well, I want to move on to commodities and FX because we do have so many questions from the audience. I would like to get to them, and to the audience, we will get there. I just want to make sure we get through all of Danielle's views first. So again, first sentence is nice and easy to get us started. The dollar may be down for the count, but it feels like everybody is already short. What is your view on the dollar at this moment in time? It has been an incredible slide, really, since that peak right when they announced the swap lines back in March, and since then it's been pretty much straight down from there. But we've seen a pause. Is this just a pause, or are we going to see some real reversal of the dollar's action?
You could call it XYZ investment when something is as shorted as the dollar is on a purely technical basis. It's due for what we've been seeing, which is a pause and the potential for a reversal. And again, if you have moderate Republicans coming out and saying, we're not so sure about this 1.9 trillion, and it looks like they're going to have to move towards reconciliation, which, without getting into what it is, means that the actual passing of the legislature takes a much longer time. So we're not talking about shock and awe and getting money into the hands of people in the next 2 weeks, which they could do if the Republicans were on board. If you start to see a lack of momentum such that the market's like, well, maybe we're not going to print money tomorrow in a big way. Because what did Janet Yellen say? Act big. Yeah. So if that's not going to be the case quickly, because you're moderate Republicans, because you're Joe Manchins of the world, because there's an independent senator in Alaska, a 50-50 margin is razor thin. And if you see that momentum is slowing on the fiscal front, and that there's no miracle in the blue wave, then you could certainly see the potential for a reversal in what we're seeing in the dollar, because right now the dollar is being trashed because they're assuming that the fiscal authorities are going to trash it.
Yeah. And what does that mean for the reflation narrative and the reflation assets that have been benefiting from this belief that the dollar will be trashed? Obviously, oil has had quite a run. Gold and silver, not as much of late, but still certainly part of that reflation narrative. How are you thinking about commodities in terms of this potential for a blue wave surprise? So blue.
I'm a real contrarian when it comes to precious metals. And if you look at the behavior of gold over long periods of time, and there are times that in deflationary times or disinflationary times that gold is outperformed, it boggles the mind, but it is what it is because it's considered to be the true safe haven, especially when treasuries are viewed as richly as they are. But there is something that I think is on too few radar screens. We're going into the second Lunar New Year in China with massive disruption in the supply chain, with a very quiet shutdown from what my friends over there are saying. And if we're in the midst right now of a margin squeeze, which we are, the supply chain disruption in the United States is severe. I mean, you've got car lines shutting down because they can't get chips. And you've got China playing hardball because they know the value of a chip. They know that they can do economic damage to withhold input materials. So you could see a situation where your commodities continue to see strength, and yet your precious also starts to recover. So I'm painting a stagflationary picture, by the way.
Yeah, and it is slightly different than the reflation narrative that so many people have clung to, that it's the printing and that's what's going to go. It's about supply chain disruption because commodities it's a short duration asset. It's about what's happening right now, not the view in the future. And so what do you think about the potential for for the recovery actually to come through and we don't see some of this reflation in these assets because it was really the supply chain disruption, the shutdowns that were driving the bullish trends that we're seeing in commodities?
Oh, look, it's been a supply demand thing. If you look at future inventories in some of these regional feds and CapEx intentions, they're like in different zip codes. So there is this restocking impulse constantly, and yet intentions to invest long term, not so much. So and to your point about this reflationary theme, Bank of America did a survey a few days ago that showed that if people have incomes of 125,000 or more, they're the ones with the savings. So my buddy Michelle Myro over at B of A, what was her conclusion? We shouldn't be too focused on what happens after reopening if the savings is concentrated in the hands of so few people. You're not going to get the same impulse. You're not going to get the same surge of people who are like, it's time to take my entire family of 10 to Disney. And the money's not that widespread. So you have to stop. And looking at averages right now, if you're looking at macroeconomic data and drawing inferences, is very dicey business.
Okay. And then as far as tactically, are there any particular assets in the FX commodity space that you like? How are you thinking about them right now?
So, as far as FX goes, again, right now, my focus really is on the dollar. You've seen the Chinese stock market go up 10, 11% year to date, and you're seeing a very strong currency. So again, the relationship between those two, at least to me right now, seems very stretched because people are ignoring the fact that China's monkeying with its numbers. Its consumer still has not recovered. It is jamming money into its industrial and infrastructure sectors. That is state-guided money. And it looks like it's going into some form of a shutdown. So there's a lot of confidence underlying. Every single sell-side strategist on Wall Street going into 2021 said the same exact thing. Asia. It's where it's at. Well, the trade's been done. The trade has been made. And yet the fundamentals backing that trade are a bit questionable. So again, remember, the reason I focus so highly on China is because China dictates what happens in this massive sell-side trade. Whatever happens in China filters through to the Kospi and Taiwan, all of these markets that have gone, sorry, I was going to use a bad word, bananas. So I think that's something that I would be focused on.
Okay. All right. Well, I want to switch gears here and get to some of these questions because we have more than I think we'll be able to get to today. So we'll jump around in terms of topics, many of them going back to bonds here. So Philip has a question that says, when you compare the U.S. yield curve to major international curves, suggests a question. How long can the U.S. curve stay so far above the rest of the world?
Well, that depends on how long the Federal Reserve sort of holds the line. There's a certain amount of nominality going on here, right? If you look at real yields, they're in the tank. But you have to consider that the virus has been approached in a much different way. I'm in Dallas, Texas, so this is kind of the wild, wild west. You go into restaurants that are jam-packed full of people, regardless of what the law is saying. So, and Europe is in full-blown shutdown, and you're seeing retail sales in France tank. So there are reasons, I think, that certain economies reflect the measures taken by their governments, or not. And that is why you see this differential. I get asked a lot, with this new administration, is there the potential for another national lockdown? And, sure, anything is possible, but I see the business community, what's left of the business community, as being in kind of a stalwart stance and saying, you're not going to take my business. You're not going to do it. I'm going to stay open. And you're seeing it's not just in kind of states where you would expect to see it. It's not. Even Andrew Cuomo came out a few days ago and said, you know what? Maybe we shouldn't let the entire New York economy fall off the map. Maybe that was bad thinking on our part. Because me personally, Danielle, I've been trying to get back to New York for months. And it's just been, it's not been tenable to even figure out how to get the testing and get there in hotels. Half the hotels are closed. So you're even seeing very liberal state governments say, we're not going to lock down. So you'll see that reflected in our economy kind of stuttering along versus we're closing the entire economy down in Germany or in France.
Yeah. Well, I guess, my question is, I just had to pull them up to make sure I don't misquote anything, but, the Italian 10-year is at, 0.65. Like how do you make sense of that? As somebody with your experience, how do you make sense of the US 10-year heading up at 1.1 and the Italian 10-year is there? What's happening? Is that just the ECB being more aggressive?
ECB, it's a new form of bond. It's a new form of bond that they're going to come up with. It's the fact that when push came to shove, Angela Merkel opened up the checkbook. So, it's existential right now because the economies there are so weak that it wouldn't take much for the euro to fall apart. People don't appreciate that, but it is a high stakes game right now. There's a reason Lagarde is so politically savvy and that she is in the position she is in. Merkel's baby is the euro. Lagarde is going to keep the euro together. And that means that Italy can continue to flaunt all of the rules that it wants. It can come into its 120th post-World War government and have the government melt down and rise back up again. It just seems like bad behavior is not going to have consequences because they've got their eye on preserving the sanctity of the euro and making sure that there's no exit of some kind, because then the rules of engagement completely change.
Yeah. It seems people are keenly focused on the potential for yield curve control. We got multiple questions about this. Bob says it's been postulated by several people that we might see it in 2021, very soon. What do you think about the likelihood of this? What circumstances do you think would trigger it? And then where do you think they pin, say, the 30-year and the 10-year?
Well, remember, Lael Brainerd is the architect of the yield curve control original blueprint. And she never did like the idea of going too far out on the curve. And in fact, she has said, and it has been reiterated in her speeches and in Powell press conferences, because the market has been jonesing for the maturities, purchases of maturities to go out on the curve. And yet they keep pushing back. So I think that yield curve control, again, 1.5%, I think that could be a possible trigger, but there's a reason there is such resistance to it within the Fed. So again, Janet Yellen could be a game changer. I'm just not going to pretend that I know why there is such internal resistance to going out the curve. Plus, the market pretty much does the business of yield curve control. And, the Fed owns 20% of the TIPS market. So it continues to kind of feed this frictional narrative that inflation could be anywhere just around the corner. But again, that's something that is being fabricated by the Fed. And people and investors followed the Fed into the TIPS market hand over foot. But if you can't create the actual inflation, then damn it, make sure the narrative lines up by engineering it. But again, I still have some contacts within the Fed, and I think if push came to shove, it would happen. But targeting that 10-year, or not the 30-year, but targeting that 10-year is something that they're resistant to do. In fact, I think the 30-year would probably be something that I own the 30-year, so still do.
Okay. All right. Well, as I said, with Spanish yields and Italian yields down there, why do you need to step in and cap yields? The market will look at that relative yield and do it for you.
And there are still insurance companies, pension funds, all manner of U.S. investors, natural organic U.S. investors who look for yields to hit certain levels and jump in. So the Fed is not the only buyer in the market.
Okay. I know I talked to George Goncalves a few months ago. Who said something very similar. He said, look, it is the last tool they have, but they really don't want to use it. So it is the end of the toolbox, because he said they're not going to go negative, but it's very close to negative rates in terms of how much they don't want to go there. They're just a little bit more willing. Okay, so just to make sure we get through some of these questions. So here, similar question. So Galen, in your previous interview, you mentioned the Fed was letting the yield curve steepen because they need a curve to cap. Do you think that, does the Fed want a steeper yield curve? And is there a point where they get a little antsy?
Does the Fed like to please the banking sector? Yes, it does. Otherwise, quantitative easing wouldn't have produced the biggest investment banking fee spike in the history of mankind, or volatility, or trading in fixed income. Yes, the Fed wants a steep yield curve. Yes, the Fed wants for U.S. banks to be robust. That's one of the reasons that there's a dark red line in front of negative yields, not negative nominal yields, because you would put the entire banking system, you would just neutralize it overnight and make it redundant. That's another reason that central bank digital currencies are also going to be someplace that they do not want to go. Look, I worked at the Fed for 9 years, and they work very closely with the banking community. The repo madness of 2019 put on full display the fact that when push comes to shove, the banks are in the driver's seat, not the Fed. So there's every reason for the Fed to not piss off the banks. So yes, they do like a yield curve to be steep.
Okay. All right. 2 questions, one from Peter and one from Lelaine, who both similar questions, which are about, asset allocation for the average person at a time like this. What do you, not asking you to give investment advice, everybody's situation is different, but when you think about asset allocation right now for the average person that they can actually access, what seems reasonable to you?
So, I'm very risk averse here. I am. That's why I talk about self-directing your 401k. It's very difficult to put these shoes on, even if I went back to my days when I did this. And we guide institutional investors. It's not a trading environment, though. And there is, when there is record low levels of cash sitting in hedge funds, that's the time to lean against what the crowded trade is. That's the time to say there's nothing wrong with being bold with my precious metals holdings and saying it doesn't have to be a 10% slice of my portfolio. It can be a third or something bigger. And cash, there's absolutely nothing wrong with holding cash. Nobody wants to do it. Nobody wants to be the one on the sideline not making the money. But you have to look through the prism of how long you're personally going to be in the workforce and how long you have to make that money back up. Because that's what you're contemplating with stocks in the 99th percentile of historic valuations.
Okay. Lelaine actually had a second part to the question, which is just to reiterate some on your position on the housing market, on residential real estate coming in 2021.
So you're starting to see a bit of saturation. Home prices are very expensive. You saw a surprise decrease in home builder optimism that, by the way, is higher now than it was during the housing bubble years. So it is off the rails. But at some point, you will start to see that there's only so much, even with record low mortgage rates, that there's only so much home that people can afford to buy. And it is a certainty that you have had the biggest wave of home buyers move into the home buying market in a post-COVID world. That exodus from the cities is not going to happen again. So you're not going to see the same magnitude of push into housing. But I will say this. I think that the Biden administration is going to do everything in its power to keep the residential housing market in a holding pattern. And that means the potential for an effective FHA bailout. I mean, delinquencies are 17.5% nationwide, 3 percentage points above where they were at the peak of the post-housing bubble. I mean, these are unheard of numbers, but nobody talks about them because housing is white hot and booming. So I would expect cash out refinancings to keep coming this year. But it is probably, again, I'm in the market for a house, so I empathize, but I've drawn the line because I'm not going to be old enough to live through. I'm not going to live long enough to live through buying at all-time highs of this magnitude when you've got home price appreciation at 14, 15% year over year. This is insanity. And it's engineered by Fannie and Freddie and drive-by appraisals and automated appraisal mechanisms they've put in place in the last 9 months in order to juice juice underwriting volumes, which were at a record high. Part of it has to do with the Fed owning more than a third of the market. I mean, a lot of this is engineered. But the part that's fundamental, which is people rushing out of the cities, you cannot replicate that.
Okay. A question from Adam on what might happen as a response to a dollar rally. He's saying that should tighten financial conditions rather quickly. He's asking about the potential for reflexive stimulus to immediately follow. I want to expand that question into just reflexive stimulus in general and policy being much more reactive than proactive at this period in time. Mm-hmm. We saw things that in 2008 took months, years to really get through, happen extremely fast in 2020. Yep. Are we still in that sort of reflexive policy instantly mode? Yep. And can you talk a little bit about Adam's question here of the dollar rally? Is he looking at things correctly?
He is. And if there's one thing that I can say about Jay Powell in his most recent press conference, it's that he's scared. Now, this is, in the beginning, he was a rebel, and it's not the Fed's job to backstop the stock market. And then he did the Powell pivot, and you could tell that there was some reluctance there because he was having an out-of-body experience, and he didn't agree with the words coming out of his mouth. But Jay Powell's afraid right now. And the $908 billion stimulus package said that they cannot replicate identically those credit facilities that have been shut down. So you almost need a different kind of an emergency to kind of go back to the drawing board. I promise you that right now at the New York Fed, they're already figuring out what they will do if there's a 10% correction in the stock market. They will be reactionary. They can say whatever they want about policy. They will turn on a dime if the markets come down because there's too much risk embedded because leverage has grown to the extent that it has. $2.5–3 trillion of non-financial debt issued in 2020. So they cannot let this thing go, and they will react to a decline in the stock market.
Okay, and what does that new policy look like? You said it's going to have to take a new form. Is there any idea of what is next? What's left in the toolbox?
So if the Fed is forced, then all the things that George Goncalves and Danielle, and in fact, we co-authored the 2021 Quill Intelligence Outlook, all of the things the Fed does not want to do, if you see them start to pull these tools out that they've been reluctant about, going out the curve, yield curve control, entertaining the idea of central bank digital currency, that means they're in DEFCON 1 mode because it is an act of Congress. Yellen will have to shepherd new facilities. I don't know what they would look like, but again, Senator Pat Toomey made sure that they could not be identical. And that was the fine print that was put into the most recent legislation that I don't think enough people are paying attention to. I think that they think that sweet Janet Yellen can just flip a switch. I don't think it's that easy.
Okay.
But they will react. They will do something.
Yeah. So we got a question from Mark sort of based on the conversation we had about Italy. And he's saying, if that's the case, why is the DXY so weak? Doesn't everyone in the US, or I mean, really the globe, know that the ECB is printing faster on a percent basis? Why is the dollar so weak then?
The Fed is the most aggressive central bank on the planet right now. The ECB's balance sheet as a percentage of GDP is twice what ours are. But right now, in terms of the sheer amount of quantitative easing being undertaken in the United States, we blow past any other central bank right now. So it's for that reason that we've seen as much weakness as we have. But again, I think that you have people like Christine Lagarde and Angela Merkel in place because they're not going to let this thing fail. They're not going to let it happen, or they wouldn't be so bold as to shut down their economies and put them back in recession. They're taking the risk of a double-dip recession on, which is something that we will not do in the United States. We're just going to throw more and more and more money at it and hope to God it holds together.
Okay. Question from Tim on inflation. You've already hinted towards your affinity for Lacey Hunt and the idea that deflationary forces are much larger than the narrative spinners would like you to believe. What do you consider? What do you think about the real risks of inflation? That some of this stuff that we're seeing with the reflation trade actually does play out and continues.
So, I jokingly sent out a tweet yesterday that said it's all about the base, but I spelled it out BASE instead of BASS. And right now you've got two factors that are working in favor of the inflationistas. You've got the base effect. So you're going to have some hot prints. The Fed's already told you they will look past them. And I promise you that the economists at the Fed know what transitory is. They know what a base effect is, and they know how to look through that. But on top of that, but it will still matter to the market. When CPI prints north of 2% on the core, it will still matter to the markets. And then you've got, as we were talking about, the supply chain disruption. So you've got freight costs that are going through the roof. Lumber's really high. Housing's hot right now, but it's really expensive to build a house. You've got auto manufacturers that are having to shut down. You've got copper, steel prices that are just bananas. Look at the grains complex. It's all gone haywire. So that is real. It's not welcome because of the potential for a margin squeeze, but it's real. And you put that on top of the base effect, which is something that you should see through. And all of a sudden, those prints really start to paint the narrative. And that's why there's this attractiveness of looking for that 10-year yield. And right now, it looks like it is really, it is stuck between 107 and 114. It has been, again, once it finds its new resting place, it's really hard to make that budge. But if you see it pop north of that, then you could see, in my view, some real opportunity because, again, the output gap, the number of permanently unemployed, demographics, baby boomers needing to retire. These are all very commercial real estate that is in the pisser. These are all very real things that will be a drag on the economy.
Yeah, it is
on pricing.
Quite the tug of war. Question from Steven, and then I think this will be the last question that I want to close with. Do you see the Fed potentially tapering QE at any point in time? And if so, what would be the trigger for that?
So I think that tapering would have to be forced, but in a good way. You would see the best case scenario play out. You would see large job creation. You would see new entrants into the workforce. We're talking about a real economic recovery that generates higher inflation for the right reasons, that allows companies that are dealing with higher input costs to have the pricing power and pass that along to the consumer. You would have to see the real economy improve, I think, for the Fed to open the discussion, because again, I saw fear in Jay Powell's eyes. He said it's not appropriate right now to be discussing a taper the last time he was at the podium. So, but what would get them there would be the metrics that they follow the most closely. It would be permanent unemployment coming down. It would be fundamentals driving the economy instead of stimulus spending.
Okay. All right. And then we got one question, which I think is a great way to close it out. The name is Dubliner, so I don't know if that's a real name or just letting us know that they're watching from Ireland. But do you hold a contrarian opinion that we haven't discussed today that you feel that most people are not talking about right now? I know you have contrarian opinions, but one that you haven't shared yet today that you think a lot of people are really missing.
No, I think that the China story, the true China story, is the one that people should be paying the most attention to, because it is such a binary narrative. So I'm always eerie about the sell side all having the same recommendation for the same asset class. So sometimes crowds can get to be true. I'm Dubliner. I'm sorry. I couldn't come up with a crazy contrarian, but you know what? I'll think about it and I will tweet it out and I will tag RealVision because it's got to be there.
Okay. All right. Well, Danielle, thank you so much. Thank you to everybody for all the great questions. It's been a lot of fun. I look forward to doing it again sometime soon.
Likewise, as well.
Thank you for watching this interview. This is just a taste of what we do at RealVision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.